Hello, class. Welcome to today's lesson. We're moving over into managerial accounting in this part of the class. So today I will be introducing management accounting and how is it different than financial accounting, and then we will proceed. So first of all, we need to take into account that accounting isn't made up of a single area. It actually is made up of many smaller areas. And frequently we start out with financial accounting, which basically is the way that we get information to users of accounting data outside the company. But we also have a number of other areas. For example, managerial accounting basically tries to provide useful information to decision makers that are within the company, in particular managers. Whereas tax accounting tries to calculate the taxes that need to be paid each period, and sometimes how they might be able to reduce these. Cost accounting sometimes is used in place of managerial accounting, but it's not quite accurate. But a lot of what managerial accounting does and the type of information that managers need to make decisions may be coming from the internal cost accounting part of the company as well. And then in addition to this, we have things like auditing, which is trying to make sure that the information produced by these various accounting systems is accurate, is prepared according to the rules. Financial accounting has a more strict set of rules to standardize and provide that information to those outside the company. But managerial accounting needs to be much more flexible because they may have much more variety in who their users are. And auditing, you can have internal auditing. These are people within the company that are checking the accounts and also trying to ensure that people aren't stealing or involved in other types of fraud within the organization. And then the external auditors, which are basically hired to tell the people outside the company whether the financial statements prepared by these companies may be trusted, whether they are prepared in accordance with generally accepted accounting principles. So let's remind ourselves what the functions of management were. And you may have run into slightly different versions of this, but in general, the management needs to prepare plans about what they want to do, where they want to get, and then they need to prepare, they need to determine how these plans are going to be implemented. And once they are being implemented, they need to check to make sure that everything's going according to plan, if there are any deviations, to make adjustments, etc. And always, this is not just kind of linear once and you're done. From each time you check to see how things have gone, that also provides you with information about what to do next period, whether the targets, goals, and objectives that had been set, whether they were appropriate, where did we have some problems, can we reach these easily, should we expand our targets, objectives. So all sorts of things can be done, but using this information about what's happened can help us run the company better in the future as well. So from this, management versus financial accounting, what's the difference? Well, both of them in general, accounting, we say the purpose of accounting, the objective of accounting is to provide decision makers with useful information. But the main difference is that who are those users changes from financial to managerial accounting. So in management accounting, the primary users that we care about are managers inside of the business. These are people making decisions on behalf of the company, like what markets should we get into, what products should we produce, how much should we produce, where to build the new factories, how to price the items, and so on. So these are the types of decisions that need to be made. And obviously, there are managers at many different levels in many different areas of the company, and they don't all require the same information. On the other hand, financial accounting the primary users that they care about are people outside of the organization, making decisions about the company, not for the company. The decisions that they make might be like, should I invest in this company? Should I buy this company? Should I sell my shares in this company? Should I lend money to this company? Or if you're the government, how much tax should I collect from this company? Are some of the decisions that need to be taken. And not all external users are equal for financial accounting. The ones that they especially care about are the investors and the creditors. They are the ones that we need to provide useful information to so that financial markets can function more efficiently and the flow of funds can occur with less problems and allow our company to operate more efficiently, be able to borrow, be able to lend, and so on. Okay, so why are we trying to produce information? Well, in management accounting, we want to help our managers carry out their jobs. So plan, act, and control. And in all of these steps, information basically a lot of the time comes from the accounting system. So this is going to be very useful to help them out. Whereas in financial accounting, again, we're trying to help them decide what to do about the company. Buy, sell, lend, don't lend, etc. Or even, do I want to compete with this company? How profitable is this market? And so on. Focus on time dimension. Management accounting, well, they care much more about the data that they produced being valuable, being relevant to the decisions that need to be taken. Whereas in financial accounting, we want the information to be dependable. So reliability, objectivity, and there's a focus on the past, not really forecasting the future. We'd like the data to be forecasting the future. However, there is a lot of uncertainty there. A lot of assumptions need to go into that estimation. So we leave that part up to the users, and the better quality the information that we provide to them, the easier their job is going to be, is the assumption. So due to relevance, sometimes the reports frequency, data that management accounting needs to provide can be quite different than financial accounting, which has these other sets of characteristics that make the data produced useful. So in management accounting, these are internal reports. They're not provided to those outside the company. So there is no restriction saying, oh, the financial statements have to be prepared according to these rules. They have to be presented in this format, etc. No, because they need to give you flexibility so that if you're a top manager in the company versus middle manager or first line manager, you're going to need different types of information, different coverage, even different frequency. Maybe for the top management, you need to provide them with reports, I don't know, once every quarter or once a year, and it needs to be summarized. It needs to be presented for the entire company. But if I'm a first line manager in charge of a particular workshop or a production line, I want information about that particular part of the business. And I don't want information about what's been happening in the last 3 months. I want information about what happened this month, what happened this week, what happened today, this morning. So the information may need to be provided much more frequently so that I'm able to keep track of these things and make corrections, make improvements if I see any problems. Whereas for financial accounting, the investors and creditors are under a huge information overload. They are keeping track of many companies, and they want the reports that are provided to them to be very standardized so that they can compare one with the other. They're able to understand what is where and what do these titles mean. So they have to fit it within the format that's provided to them, and use the generally accepted accounting principles so that this should prevent or make it at least more difficult for companies to make themselves seem to be more attractive, more valuable than they really are. So that's what we need those rules for. So what type of verification do we have? Well, in management accounting, this is inside the company. So sometimes you might have your internal auditors take a look at this, but this is not required by law. Again, because you're doing this within the company, you're providing the information to people within the company. So there is no outsider that you're trying to teach, that you're trying to maybe cheat, excuse me. But towards the outside, we need to have our financial statements audited by independent external auditors. What are these people doing? Well, basically, there are people experienced in the rules and regulations that need to be followed, and they need to check to see whether those rules have been followed in preparing these financial statements. Because if this isn't done, companies would, probably try to cheat or make themselves look much better than reality quite frequently. And that would end up harming the dependability and the usefulness of the accounting information. So by going through this additional step, we are trying to make it more difficult for companies to manipulate, to play with the data, and hopefully make the information more dependable so that people feel safe using this data in their analyses, in their decision making. What kind of information is presented in management versus financial accounting? Well, in management accounting, you can have very detailed reports about individual parts of the company. Again, it depends on which manager we are trying to provide useful information to. If it's the CEO of the company, we probably provide them with information about the overall company, and probably summarized. But if they want to, they can go into much more details into sub components of the individual parts. So it also needs to be flexible. But if the manager I'm trying to help right now is a lower level manager in charge of a particular aspect, particular department, particular facility of the organization, then they only need information about their own part. And for privacy concerns, I don't want all of the information of my company to be reachable by everyone inside the company and potentially getting stolen and going outside of the company to my competition and all sorts of people. So in order to ensure this, the system needs to prepare reports for the managers at different levels that are customized to their needs in terms of content, in terms of frequency, and a lot of other things. So much more detail in the reports of management accounting, especially if you're in the lower levels. Whereas in financial accounting, again, these investors, creditors need to evaluate the financial statements of many companies over a year, over a month. So they don't want to spend a lot of time learning the intricacies, the details of each company. So they want the report to be very standardized so that this allows them to look at the report and quickly understand what's happening, what are they doing well, what are they having problems with, and what kind of an evaluation to do about this company. And again, it is looking at the overall organization. It is looking annually or quarterly, currently not more frequent than that. There are plans to allow maybe monthly financial statements to be able to produce, or maybe even more frequently, but that's not happening, at least not yet. Again, something that we need to be aware is that anytime a manager measures something and then uses it in their decision making to give bonuses, to determine prices, well, you need to be careful, because sometimes you might be providing strange incentives which actually may be harmful to the organization. So when you ask people to report about how they're spending their time, or about the cost structure of different things, you may all of a sudden find that their behavior is changing when they're being followed. So, for example, if you are simply measuring how many units are being produced, and you are also compensating according to how many units are produced, then you will probably find out that your employees' productivity does go up. They produce more units. But to be able to do this, maybe they're going to do it very quickly, and this may actually be harmful from a quality point of view. They may actually be not spending enough time on this. And actually, this might be harming the sales and the profitability of the organization. So you need to be careful in what you're measuring and how you're compensating, how you're trying to motivate your employees. Concerned about adequacy of disclosure, there's always an argument about how much information we should be providing to the financial accounting statement users. And the trend has been to continually add more and more data to the annual reports, and they've gotten 100, now about 200 pages for each annual report. And still, there are arguments that, we should be providing more detailed information, additional things, this, that. But again, is this enough, or is it too much, is an argument that is continuing. So the argument is that any information that potentially can change the decisions of decision makers is relevant and should be announced. But another thing they need to be careful about is typically producing more information about new aspects costs money. So just like you do a cost-benefit analysis in most of your decision making, cost-benefit analysis also needs to be done when choosing between, do we want to provide this additional information or not? Okay, because it will be bringing additional costs. Are the benefits sufficient to rationalize doing this? And this is one of the decisions in financial accounting, which is done by the standard setters, not necessarily the individual companies. What else do we have? Well, in financial accounting, typically the examples that we have been taking a look at were either, service companies, initially when introducing the accounting equation and, the journal entries and so on. In order to keep things simple, we were using the example of a service company, like an entertainment company or any type of service providing company. And basically services are intangible, right? Like education, like entertainment and so on. Whereas a lot of the companies in the world out there sell physical, tangible products, okay? Then in financial accounting, we typically examine merchandising companies. These are companies that sell products, but they buy the products ready to sell, okay? So they don't really change the characteristics, the shape, and so on of the things that they buy. They buy them, they might at most maybe repackage them a little bit, and then they sell them. But there is another type of organization, and is more detailed than this, and that's one of the things that in managerial accounting we will be taking a closer look at. And those are manufacturing companies, companies that buy raw materials and then convert these raw materials into finished products, like an auto producer that buys metal, they buy seats, they buy engines, they buy tires, they put them together, and then the output that comes out the other side of the factory is a finished automobile, which they sell. So in this case, there's more detailed, more complicated work going on. And obviously, we're going to see there's more types of inventory which need to be kept track of and where it is on the production line, because we're not buying the goods ready to sell, like in the merchandiser. We're changing the characteristics of those goods. So we need to be able to follow what's going on. So for these companies, we're going to introduce some additional types of inventory. Before, we could call it just inventory. But that actually those were finished goods inventory, because we were buying them finished in order to be able to sell them. In Turkish, sometimes we use a few different terms for this. For the goods that are bought ready to sell, we call them emtia, E-M-T-I-A, emtia. And then we have materials, typically raw materials or semi-processed materials. And then we have work in process, aramal, yarı mamul, ham madde. And then we have finished goods inventory, mamul mal. Okay, so it is these finished goods. They come into materials, raw materials, and then they get put into the production process, in the working process. And then when they're finished going through this, they become finished goods in a manufacturing company. And then they are put into inventory. And when they're sold, they become cost of goods sold and they go to the income statement. So this is basically what we need to follow. And also keep in mind, under materials, this is not just a single account. This is a controlling account. There are many sub-accounts. You have different types of materials, raw materials. You have different qualities and so on. So each of these would need to be followed independently. And the accounting system will allow you to drill down and see what type of inventory of what type of items you have. But the controlling account will give you the total of all of these sub-accounts that you have. And what we're actually examining is what is going on in the company's value chain. And value chain is basically everything that happens from idea to purchasing the materials to converting them into finished products. And actually, even after finishing the production, then selling, distributing, and even after sales services form parts of the value chain. And in each part of this, the company has a chance to add value. Okay, if they're doing a good job, they are adding value, so increasing the perceived value of the things that go through these in steps. So in R&D, you're trying to determine what do the customers need, what do they want, how can we satisfy this, and then you design a product which meets the needs, and maybe with the new technology that also comes up out of R&D. And then this design needs to go to the production facility where you are producing them or sometimes buying them. And then the marketing area decides how to promote these products that you have now ready to sell. So advertising and sales go in here. And then you distribute these. You might be selling them in your own stores. You might be selling them online. You might be sending them to wholesalers, retailers, and then they might finally be getting to the customer, or you might be selling directly to customers. A lot of different ways of distributing your products as well. And then you're not done just because the customer has received this. You also have customer services. So how to install something, how to use something. And if they're unhappy or if they need something corrected after the purchase, this is also part of the value chain where companies are continuing to add value. And by adding this value, later they're able to make money from charging for some or all of these. So a few more definitions. Cost object. A cost object is basically anything for which you might want to calculate a cost. It might, a cost object might be, okay, how much does it cost to produce one of these? So this is a cost object, very common. Or it might be, how much are we spending on advertising of these products? How much was the R&D? How much are we spending on educating our employees? So anything that you want to determine the cost of can be a cost object. Sorry for the noise. A cost driver. So this is basically the things that when you increase their usage, for example, electricity, how much time are you keeping it open? How many watts are you using? Or how many miles are you driving with your vehicle? How many hours are you having your employees work, and so on? These are the factors that cause the cost to increase. So we need to understand what are the things that are increasing the costs, so that if we want to understand, or if we want to estimate how much the cost of something is going to be, we can follow these cost drivers. Okay, so what are some common examples of cost objects? Well, as I said before, individual products. How much does it cost to produce 1 unit of this is the most typical one. But you might compare, for example, if we advertise this in newspapers, how much is it going to cost? If we advertise this on television, if we advertise this online, if we advertise this on billboards, these are all alternatives. You don't have to use all of them together, or you don't have to use any of them if you don't want to. But I want to know how much each of these is costing me. And hopefully I'm also able to measure how much revenue, how much return it is bringing to me, so that I can choose the ones that are more effective, that are more efficient in helping me sell. So definitely different marketing strategies could be cost objects. Or how much is our factory in Istanbul costing? How much is our factory in Izmir or in Ankara costing? Or how much is our operations in Turkey costing? So all of these may also be different cost objects, or within a particular company, you might be looking at different departments. So how much are we paying to the what is the cost of our HR department or our finance department? Because again, I want to keep track of what's going on there. And maybe, I might want to hire more people, and I want to see how it's going to affect our budgets, how it's going to affect our cost, but also potentially the work which is being done in there. Or perhaps you might want to see, the spending here, as how much has it been growing? Has it been compensated for with additional sales, or are we becoming less efficient? So these are things which we would definitely want to be keeping track of. Okay, and then different classifications of cost. We're going to see a lot of these. Direct costs are those costs which can be traced to individual cost objects. And so the typical examples of this, if an employee, if a worker has to work 5 hours to produce a particular table, then his labor is a direct cost because it can be followed directly to the production of that table. So direct costs. Whereas indirect costs are more difficult to follow to individual products, individual cost objects. For example, the labor of the person producing that table, we said, is a direct cost, but the labor of the person cleaning the factory, or the wages, the salaries of the managers in charge of that factory, can they be traced to individual cost objects? Typically not. So they are indirect. They may be contributing, but we don't know how much of that contribution is going to which actual unit that is produced and so on. So they are indirect in that sense. But are they still costing the company money? Yes. Does it still need to be followed? Definitely yes. But we're going to need a way to allocate those indirect costs to the cost objects as well, which is one of the things that managerial accounting deals with. So what are product costs? Okay, so the cost to produce or purchase, so product costs were easy for merchandisers, where you were buying goods ready to sell. So in that case, it was basically how much did you pay for it? And you might also add on how much did you pay to get it ready for its intended use, to get it to your factory and stuff like this. But it could also be in a manufacturing company, it's going to include, everything needed to produce a particular product that you want to send, that you plan on selling. Okay, so product costs can be grouped into 2 main parts: full product costs versus inventoriable product costs. So inventoriable product costs are what your financial accounting says need to go into that, whereas full product costs may include some things which financial accounting doesn't necessarily put into it. So for external reporting, financial accounting, the inventoriable product costs and period costs. end up being separated, right? So inventoriable product costs end up in the balance sheet under inventory until you sell them, wherein they become cost of goods sold. On the other hand, the period costs directly go into the income statement. They don't flow through the balance sheet, and typically they're part of your operating expenses. Okay, for external reporting, merchandisers' inventoriable product costs include only the costs that are incurred in the purchase of goods, right? For a merchandiser, how much did you pay to buy it? And in financial accounting, you may have also, basically said, oh, the cost to get it to you and insurance and stuff like that may also be included. Yes. Inventoriable costs are an asset, right? So they become part of your balance sheet inventory, typically under current assets. Whereas period costs directly go to the income statement. They don't live for any time in your balance sheet. Okay, manufacturers' inventoriable product costs are a little more complicated. So how much did you pay for the raw materials? How much did you spend to convert those raw materials into finished products? So all of the costs incurred in the manufacturing process basically can or should become part of the inventory and end up in the balance sheet. Inventoriable product costs are incurred only in the third element of the value chain, the production process, right? Costs incurred in other elements of the value chain are period costs. Now, for example, research and development, or sales, or after sales services, and so on. These do not become inventoriable product costs. They are period expenses and typically in operating expenses. They don't go through the balance sheet. They go directly to the income statement as expenses. So how do we classify these inventoriable product costs? Well, in general, we can argue that there are five types of these costs. So direct materials, direct malzeme. So the raw materials that you buy, if this is an automobile producer, it might include steel, it might include rubber, it might include tires. Some of them might be partly produced. You might be buying the engines already built and then installing them into your cars and so on. So direct materials. Direct labor, the money that you're paying the employees working directly on the production line, direct labor, which can be traced to the job that they're working on at that time. But you also have indirect labor, right? So the people cleaning the factory, the people working on, keeping track of the inventory in the company and so on. They don't directly work on the production line, but they do contribute to the operating of the factory. So we need to take their costs and somehow find a way to assign these costs to the relevant things being produced. Similarly, indirect materials are also like this. So this could be the cleaning materials that are being used in the factory and others. You always need another. For example, are you heating? Are you cooling the factory? Are you lighting the factory? So electricity used. Part of it might be, directly traceable, but a lot of it is going to be general, and this much is used in the company, but you might not be able to trace it directly to the individual products. So typically, again, sorry for the sound, but these last three, indirect labor, indirect materials, and the other costs, are called manufacturing overhead. And, it is difficult to assign them directly to particular units, particular cost objects. So one of the things that we have to do in management accounting is find a way to take these costs and divide them by the products that we have produced and assign part of that cost to each of these. So there's a number of ways to break these up. Another way is what we call prime costs. So these are the things that go directly into that product. So the direct materials and the direct labor are referred to as prime costs. And then can have conversion costs, which is basically the costs that we have to convert raw material into the finished goods. So this includes the manufacturing overhead we mentioned before, indirect labor, indirect materials, and other costs, but it also includes the labor because it's not raw materials. We are using that direct labor to convert the raw material into a finished good, together with the indirect labor, indirect materials, and other costs that we see here. So these are called conversion costs. And then what do the financial statements of these companies look like, and what things relevant to merchandisers and service companies and manufacturing companies, especially with regard to inventory and with regard to cost of goods sold and stuff like this? How do they appear like in the financial statements? So in a service company, there is no inventory, and you're not selling anything, so there is no sales revenue. Typically, you have service revenue, you might have rent revenue, you might have, basically other types of revenue that you're earning for having provided services. It might be a car wash, so you're washing cars, right? So that is a type of service revenue. So no inventory, and thus no inventoriable costs in a service company. So also in the income statement, balance sheet, no inventory. Income statement, you don't have cost of goods sold. You simply have your revenues, whatever types there are, and then minus the expenses, and that gives you your operating income. And then you would deduct interest expense and tax expense if you have those as well. For a merchandising company, what happens is you have your inventory. So in this case, the inventory cost that you put in there is how much did you pay to purchase and get the material to you, so plus freight in. And these, as they're bought, they go into your inventory account. And as you sell these items, it's taken out of inventory and it becomes cost of goods sold expense in the income statement. So you deduct cost of goods sold from sales revenue, and this gives you your gross profit for this company, answering the question, were you able to sell the things that you purchased at a price above what you paid to buy them? And the remainder, the other costs, period costs, which don't go into this inventory, we call them operating costs. Okay, as you spend the money for operating costs, they become, they go directly to the income statement, again, as you use them up. And when you deduct operating expenses from gross profit, you end up with the next profitability measure, which is operating profit. Okay, also typically called EBIT, earnings before interest and taxes. In a manufacturing company, it becomes slightly more complicated in that when you buy the raw materials, they go into materials inventory, raw materials inventory typically. And then as you pull them out of that and send them to the factory floor onto the production process, something is taken out of materials and added into work in process. And this is where the actual transformation of those raw materials and parts are being done. And then as they are completed, they leave the work in process account and they move into the finished goods inventory. And this basically means that they are ready to sell. And if and when you sell them, they basically end up becoming cost of goods sold expense in the income statement. So again, deduct cost of goods sold from sales revenue, giving you gross profit. Deduct operating expenses, gives you operating income in our process, in our accounting. Maybe to make things a little more concrete, let's try to give some numbers so that we are able to understand what's going on. So this company basically has work in process. They may have other numbers in raw materials and stuff, but we're simplifying it initially. So work in process, that middle step of inventory, began the year with $20,000 in work in process and ended the year in $18,000. So basically, as the goods were added into this, and then the production process was completed, the balance was reduced by 2,000. So some that were in there from the previous year also were completed and left going into finished goods inventory. So in addition to work in process, 20,000 that we had at the beginning of the year, we used $70,000 worth of direct materials. So when you use it, the direct materials, it is taken, it is removed from the inventory account of raw materials, and it is transferred into work in process. And then in addition to direct materials, we also had direct labor of the employees working on the production line, 100,000. So this also is added into work in process. And in addition to these direct costs, right, we also had manufacturing overhead. So indirect labor, indirect costs, indirect materials, and other costs of 150,000. This also, it might be accumulated in an account called manufacturing overhead, but then it needs to be transferred into the work in process account. And as things are completed, they move into finished goods. So if we want to try to calculate the cost of goods manufactured, how can we do this? So this basically is how much have we added into our finished goods inventory for the period. So to do that, we need to see what's happened in work in process and how much has moved out of work in process. So initially, we had $20,000 worth of inventory in work in process at the beginning of the period. We added direct labor, direct materials, and manufacturing overhead, numbers given before, so adding up to 320,000. If you add these together, 340,000, this is the maximum that could have been completing the work in process and could have been sent into finished goods. However, the end of year count shows that there is still $18,000 worth of work in process left. The production of this has not been completed. So deducting work in process from the two numbers above, we end up with a total cost of goods manufactured, completed, and sent into finished goods inventory of 322,000. So if we are also given the information that the finished goods inventory for this company at the beginning of the year was 60,000 and at the end of the year was 55,000, together with the number cost of goods manufacturing coming out of work in process, what ended up happening? How much was our cost of goods sold for the period? Well, beginning finished goods inventory, 60,000, plus from our previous calculation, cost of goods manufactured, 322,000. This tells us that adding these two together, 382,000 is our total cost of goods available for sale. So if we sold everything we had, everything in the warehouse, everything on the shelves, this could potentially be your maximum cost of goods sold. However, as we know that at the end of the year, we still had $55,000 worth of ending inventory, ending finished goods inventory, then basically this means that your actual cost of goods sold was the difference between these two items, 327,000. So 322 cost of goods manufactured plus the reduction in inventory during the period. You can also look at it in that way. So 327,000 would be your cost of goods sold in your income statement, sent to the income statement as an expense. If during this period, the company basically had sales revenue of 627,000, what would the income statement look like and how much gross profit would the company have made. Okay, so sales revenue, 627,000 minus the cost of goods sold, 327,000, shows us that we had 300,000 of gross profit. Okay, so we were able to sell our inventory that we bought and that we produced for a price exceeding its cost by 300,000 is what this partial income statement is telling me. What else do I have in addition to this? Well, in addition to cost of goods sold, they also had a number of period costs, as we saw before. So these period costs are going to be becoming operating expenses in our income statement. So they had salaries and commissions of the sales employees, 80,000, delivery expense. So be careful, this is delivery of the goods that you have sold and are sending to your customers, not for bringing the inventory to your company, because that goes into inventory cost, whereas this is an operating expense. And other administrative expenses, 30,000, total of 120,000. So putting this information into our income statement as well, we end up with something that looks like this. So before we had calculated the gross profit as 300,000, deducting operating expenses of 120,000, we end up with operating income or EBIT of 180,000. So if we try to visualize what's going on again, and again, I apologize for the sound that the presentation will be making, but this is what it looks like. So the flow of costs through a manufacturing company's accounts. So first, we have our direct materials inventory over here. So we have a beginning inventory, which includes any amounts that are left over from the previous year in raw materials. In addition to this, we buy some additional raw material this period, plus including the freight to get it to your store. So the sum of these is the direct materials available to be used, maximum that we could use. But if we have some left over at the end of the period in ending inventory of direct materials, then deducting this tells us the total amount of direct materials used in this period. So this ends up being added. So it's removed from direct materials or raw materials. It is added into work in process. So there was a beginning inventory in work in process. You add the direct materials that were used, that were given into the production process, into this as direct materials, plus any direct labor and these manufacturing overhead, indirect labor, indirect costs, indirect materials, and other costs is added on top of that. And this gives us the total manufacturing cost to account for. So if we finished production of all of the work in process, this would be transferred into the finished goods inventory. But because we typically have a certain amount of work in process left at the end of the year, it needs to be deducted from this amount to give us the cost of goods manufactured, which is taken out from here and it is transferred into our finished goods inventory because the production has been completed and now we're waiting for the customers to come in and buy it. So in my finished goods inventory account, I have, again, beginning inventory from the previous year's production process, which were not sold. In addition to this, the new cost of goods manufacturing of this period, that gives me the cost of goods available for sale. Again, this is the maximum that I could sell out of my finished goods inventory this year. If I have any left over at the end of the year, that is recorded as ending inventory and I deduct it, which then allows me to calculate the cost of goods sold for this company. So that concludes my introduction to managerial accounting. I hope you found it useful, and we will have at least a few more sessions to complete our basic overview of management accounting.